Hey everybody, Smart Silver Stacker here. Hope you're doing well. Welcome to another live stream. So we've got a lot to talk about today, namely the setup that we are seeing for perhaps the biggest fiat dollar devaluation in history. And that might sound like an exaggeration, but when you look at what the Federal Reserve just told us, the central bankers over at the Federal Reserve, what they've told us in the past 24 hours, I think you will find that there is reason for concern here, and that now is the time to be getting prepared for a major dollar devaluation and a huge round of fiat money creation, the kind that we've never seen before in the history of the economy, of the global economy. So starting off, let's just take a look at what's going on with the dollar index today. So kind of a wild ride. We had the release of the non-farm payroll data from the Bureau of Labor Statistics this morning. Now, initially, on the release of that data, you had the U.S. dollar plunging. Dollar index was down significantly. Now, since that time, as the markets have digested this data that was released, we've seen quite the recovery in the dollar, and at the same time, a pretty significant sell-off across markets. The NASDAQ down 2.6% right now. The silver price, the spot price, down over 3%. You can see a significant red candle. And interestingly, it's sort of the inverse of what happened with the dollar. Earlier in the session, we had silver back above 29 bucks. You can see this red candle wick all the way up to $29.12. But since then, sold off basically a whole dollar in the silver price. Gold, it's a similar story, although the sell-off has been a little more muted there, but still pretty solid red candle there. You can see gold earlier in today's session was trading as high as 25.16. So coming up on record all-time highs, and yet now back under 2,500. So I guess a good place to start here is the data that was released this morning from the U.S. Bureau of Labor Statistics, the total non-farm payroll employment increasing by 142,000 jobs in August. Now, that was a miss. It was not as good as what was anticipated. I think the forecasts were for something like $160,000 or 160,000 jobs added, but this is not bad enough to put a lot of confidence in markets that more easy money is coming. And if we take a look at the CME FedWatch tool, you can see that the chances, well, what markets are pricing in here for a bigger rate cut, a 50 basis point rate cut at September's FOMC Federal Reserve meeting, is now 25%. Now, yesterday, that was as high as 40%. So the impact of this jobs report and the unemployment rate also changing little, this has caused markets to feel like the labor market is perhaps strong enough that the Fed can cut at a more leisurely rate. But when we look at the real reason that the Fed has to begin cutting rates, and we'll get into that in a moment, and what the bankers at the Federal Reserve have just told us, I think that this is, the markets are getting this one somewhat wrong. Now, interestingly, also, something we need to look at is this little note here. You notice it's at the very end of the report, and seems like markets are not giving this much credence, but the previous month's jobs numbers, remember the really terrible job report that we got last month, 114,000 jobs added, that was so much worse than what was expected? Well, that has been revised down further by 25,000 jobs, and June's number has been revised down by 61,000 jobs, from 179,000 to 118,000, and then July's number was revised down from 114,000 to 89,000. Now, this is one of the tricks that the BLS likes to play. They report a higher number, all the trading algorithms, all of the investors just look at that headline number, and then they revise it significantly lower in the following month. So this paints a much rosier picture of the job market than is actually occurring, and then later on down the road they just revise those numbers lower. So let me know what you think. Is the 142,000 jobs that we added in August, according to the BLS, accurate, or Do you think that's going to get revised lower in the following months? Put a 2 in the chat if you think that that number is going to be revised lower in the future. If you just look at every month that we've had previously, I mean, the trend is to revise the numbers lower. Of course, last month they revised the total jobs added from March of 2023 to March of 2024 down by over 800,000 jobs. So you can't trust any of these numbers. This is all cooked stuff. Yeah, the Bureau of Lying Statisticians, that's what Rolf Steiner says in the chat there. That is probably a better moniker for this part of the government than the Bureau of Labor Statistics. And I do see a lot of you chiming in the chat there. Thanks for watching. Thanks for tuning in. Do me a favor. Smash the like button if you haven't done that yet. Subscribe to the channel if you haven't done that yet. And, you know, when you look at what the Fed is telling us here, I think we have to view every rally in the dollar and every decline in gold and silver as an opportunity to get prepared for the massive devaluation that is coming. I mean, gold today back under $2,500. I think this is a steal. Gold down, silver now under $28 again. I mean, if you thought that you missed the opportunity here in the dip that we had last week, well, it looks like you're getting another chance to get some physical silver at a discount. On that note, you can check out today's video sponsor, SD Bullion, with the link down in the description. They have some really nice sales right now. You can get a silver maple leaf coin at spot. You can just tack that onto your order. They've got silver rounds, 99 cents over spot, and US 90% half dollars haven't been minted since, in over 6 decades. You can get those for $1.99 over spot. So check them out with the link down in the description. Now, this is what we're hearing from the central bankers at the Fed. And, the markets do like to hang on every word that these guys utter. So when they talk, it's important. And what they're telling us is that there's a lot of easy money coming. So this is Fed Waller. He says that the Fed is open to more forceful moves down the road based on the data. Here's a quote from him. He says, as of today, I believe it is, and this is from yesterday, as of today, I believe it is important to start the rate cutting process at our next meeting. While I expect that these cuts will be done carefully as the economy and employment continue to grow, in the context of stable inflation, I stand ready to act promptly to support the economy as needed. So what he's telling you there is any sign of economic weakness will be met with easy money. And why would we think anything different? Of course, every time we get any kind of economic downturn over the past several decades, in COVID, great financial crisis, the popping of the tech bubble, what does the Fed do? Well, they cut rates and they reinflate the bubbles. Now, this is important. He says that if the data supports cuts at consecutive meetings, then I believe it will be appropriate to cut at consecutive meetings. So we may get multiple cuts before the end of the year. And then he also says that the FOMC can act quickly and forcefully to adjust monetary policy if subsequent data shows a significant deterioration in the labor market. Now, what does that mean? Act quickly and forcefully? Well, to me, that means that they're not just considering rate cuts here. They are considering what might be considered more forceful measures, such as a return to quantitative easing. And I believe that is likely what is going to happen. We'll cover some more data here in just a moment, which I think supports that. But first, let's look at what Chicago Fed President Goolsbee says. He says that jobs and inflation trends justify multiple interest rate cuts and soon. So they are going to be cutting, and they're likely going to be cutting a lot more than markets currently anticipate. Now, here's the real reason. It's not because the Fed is concerned about the job market. The job market has been trashed for years now. I think we all know that. I mean, regardless of what the BLS tells us, they say, hey, it's great that, we're adding all these part-time waitress and bartender jobs as people are forced to look for second and third jobs to support themselves in the midst of inflation. We're told this is the strongest economy on record, that there's a huge recovery, right? Despite the fact that many of the jobs added were simply people going back to work following the COVID shutdowns. Despite the fact that many of these jobs, again, are second and third jobs. That's not a sign of a strong jobs market. That is a sign of consumers being incredibly pressured by inflation, which is about to get a lot worse, by the way, because of what the Fed is going to do. Now, look at this. This is the real reason that the Federal Reserve is going to need to be more forceful than just rate cuts. This is from MarketWatch. U.S. debt costs $3 billion per day in interest. Now, MarketWatch says rate cuts would only scratch the surface of fixing the problem. And that's true because the reality is here that $35 trillion is simply a massive unpayable level of debt, and the interest is going exponential. Think about this, $3 billion per day in interest on the U.S. national debt. Just think about that in terms of silver. I mean, silver today is what, $28? We produce about 1 billion ounces of silver per year from mining and recycling. So a whole year of silver production is worth about $28 billion. Now, the U.S. government not is borrowing more than that, but we are paying that much in interest in 10 days. So every 10 days, the entire market cap of a year's production of physical silver is paid in interest alone on the debt. And you can see it on this chart from the Federal Reserve Bank of St. Louis. This is the interest on the national debt, the interest payments that the federal government is paying. You can see, I mean, it's sloped up for years, going back all the way to 1950. And then since 2020, when they really began expanding the debt, quantitative easing, expanding the Fed's balance sheet, enabling massive levels of government borrowing to the tune, again, of about $35 trillion, the interest has simply gone exponential. This is not sustainable. You cannot continue to pay this level of interest without the debt just completely exploding. I mean, eventually what ends up happening on this kind of a timeline, not too soon, I mean, it doesn't take too long for it to happen, is that the interest will simply take up all of the tax receipts. So, I mean, that I think is a point where you can say you've truly crossed the point of no return. I think we're already there, but you know, right now the U.S. interest is sitting around $1.1 trillion annually. That number is rising on a very, very sharp exponential rate. So eventually, just all the tax revenue goes towards paying interest alone on the debt. Then what do? You keep borrowing. Eventually, you're going to have to either hyperinflate your currency or default on the debt. I think we're already at that point. Now, what is the Fed going to do? Are they going to allow the Treasury to default? There's not a chance. They're going to pay off this debt in devalued currency. To give you another idea of this, I mean, let's look at the debt clock. So $35.35 trillion now. Wow, that went up a lot over the past couple days. I think we did a live stream earlier this week. It was 35.28. So, you know, the debt is rising drastically along with the interest on the debt. But just take a look at the time machine here. We go back to the year 2000. So in 2000, the U.S. national debt was at $5.5 trillion. So in the entire first 200 years plus of the country's history, we borrowed $5 trillion. Now, in the 24 years since that time, we have borrowed an additional $30 trillion. Kind of makes you think, right? The debt is rising exponentially. The interest is rising exponentially. They have got to get interest rates down. Cutting the federal funds rate is not going to be enough. That's not enough. As MarketWatch points out here, that, you know, scratching the surface of the debt interest problem is what you get when you cut rates. So what are they going to have to do? Well, they're going to have to buy up the debt, right? They're going to have to create money out of nowhere to buy up U.S. treasuries to drive the yields drastically lower to enable more debt creation, more borrowing. That is what is going to occur here. Unless you think that whoever gets into office in November is going to slash the $2 trillion deficit. They're going to slash government spending. They're going to balance the budget. They're going to cut everybody's Social Security benefits. They're going to reduce all the entitlement programs. Obviously, that's not going to happen. It's completely politically unviable. So the only other alternative is that the Fed gets in here, becomes very active in these markets, and buys up huge amounts of debt. Now, why is that a problem? Well, because it's massively inflationary. Of course, if you're the government, if you are the biggest debtor, that's exactly what you want, right? Massive inflation benefits borrowers, those who have huge amounts of debt, because you borrow the money, you buy assets with it, or in the case of the government, you just funnel the money into the pockets of special interests and the military-industrial complex. But you get the point. You get first access to the money, then you devalue the currency and you just pay it back in devalued paper. Right? And this benefits the wealthiest in society. It steals wealth from the lower and middle classes. This is a way to send wealth to the higher tiers of society because, if you're a millionaire or a billionaire, you're sitting on a pile of assets. All of that money creation, it just makes your assets go up in value. It diminishes your debts. And, if you're sitting on millions of dollars, what do you really care what the cost of food or gas is? Such a small portion of your monthly or daily or weekly budget, however you want to cut it, it goes towards those necessities. Whereas, those of us in the middle class, the lower class, as peons, we're going to be, impoverished as a result of this. And, depending on who gets into office in November, you might even see things like confiscatory wealth taxes. So, even if you're stacking gold or silver, let's say you stack a pile of gold goes to $10,000, maybe you have to pay unrealized capital gains taxes on that. Basically just, your gains are stolen. I mean, it's really a con game here. You take honest money like gold and silver, you remove it from the currency, then you create huge quantities of the currency. You have your central bank buy up all the debt. I mean, you can see what's happening here. Nonetheless, I do think that one of the best ways to prepare for this is by having physical, tangible assets outside of this system, money that can't be printed, money that's been around for thousands of years. I mean, I don't know, maybe they confiscate your gold and silver. I think the logistics favor the stackers. One thing's for sure, any cash that you have, any digital assets, those are rife for being frozen, for being confiscated, for being devalued. And therefore, I think it's a good idea to have some physical assets on hand when you look at what is ahead. And, look, this is all going to be in a phase of flux, I think, until the Federal Reserve's FOMC meeting here in the end of September, September 18th. That meeting kicks off. I think it's very possible that we could see more volatility in these markets up until that point. It's possible that there might be even lower silver prices, even lower gold prices, even lower prices in these markets. Things might bottom on the announcement of actual rate cuts. But then once the effects of the easy money begin trickling into the economy, these bubbles in asset valuation, like in the NASDAQ and the S&P, those are going to be blown to unimaginable heights. Gold and silver, they're going to be heading much, much higher. And then if it turns out that I'm right, that, it's going to be a lot more than just rate cuts, it's going to be quantitative easing, it's going to be direct debt purchases, it's going to be massive currency devaluation. Well, gold and silver are going to do very well indeed. And, I think it's better to have some physical than perhaps, the SLV, the GLD, paper gold and silver in a trading account. You want to get the real thing before that happens. And, if there's some kind of a financial crisis, which is very likely, what will give the Fed the cover to begin that round of money printing, then the things that are probably going to do the best are going to be assets that we've seen do very well in the event of financial crises. If you remember what happened back in March of 2023, junk silver, well, you could barely get this stuff. Premiums on it exploded. It's a very limited supply, and when things start falling apart, demand is on the rise. That's why I think this is one of the best things to stack right now. But let me know what you think. Leave me a comment down below. Let me know what you think about the Fed's future moves. Why is the dollar rallying today on this bad jobs data? Do you think that the jobs data is going to get revised lower in the future? I always like to hear what you have to say, so leave a comment down below. Let me know what you think. Stay safe and happy stacking, everybody. Smart Silver Stacker